Today, we're going to dive deeper into the complex topic of automated market makers on decentralized exchanges, how they function, what they are, and how you can earn passive income using them. Let's hop in. I'm Jake Call, the founder and CEO of BuildrWealth, and when I established this company, I had one goal in mind, and that was to bring liquidity pooling as well as decentralized finance to the masses and help onboard them. So that's the main mission behind our companies, help people like you get into this complex space that is not easy to navigate whatsoever. So if you enjoy that, drop a like and subscribe when notifications turned on. But diving right into the video, you've probably heard of decentralized finance. And decentralized finance is just an emerging financial industry with many different aspects to it. It's supposed to combat TradFi, and it uses cryptocurrency as well as blockchain technology to host a financial system, basically. We did a video on what DeFi is a couple weeks back, but today we're going to be talking about decentralized exchanges and automated market makers. You might have heard this terminology before: DEX or AMM or decentralized exchange or automated market maker or a liquidity pool or something along those lines. Well, that's all the stuff that we're going to be covering today because that all falls under the automated market makers. So quickly talk about what an automated market maker is. It is basically a system or algorithm or whatever you want to call it that matches a buyer/seller with a buyer/seller basically automatically. Now this is different because it's not using an order book where there has to be a buyer and then there has to be a seller basically. Instead, what the automated market maker utilizes is a buyer/seller and then a liquidity pool where anybody can deploy into this liquidity pool to become a market maker and allow trades to happen. And in return, this buyer/seller is just trading with the liquidity pool. So the difference between these two is in an order book, it's somewhat manual. A buyer has to open up a trade and then a seller has to open up a trade. Whereas in an automated market maker, only the person that wants to trade has to open up a trade, and that trade is automatically filled. Automatically filled, nothing has to happen. It's automatically filled through the liquidity pool basically. So that would look something along these lines. Over here we have the liquidity pool, and then over here on the left we'll have the trader. Now let's just say this liquidity pool is Ethereum and USDC, right? Similar to how you can have an Ethereum to USD pair over on Binance or another centralized exchange. We're going to assume that this is an Ethereum to USDC liquidity pool. Now keep in mind there can also be stuff like Ethereum to wrap Bitcoin or Ethereum to Matic or other assets like that paired with Ethereum or paired with stablecoins. Anybody can create any liquidity pool and any pairing. That's the beauty of it. But the basis is if there is an Ethereum to USDC liquidity pool, well, there's going to be both Ethereum tokens as well as USDC tokens in this liquidity pool. For simplicity purposes, let's assume this totals like $100,000 basically. Well, this trader can come along and they can trade their Ethereum for some USDC. And what they're doing is they're adjusting the balance of the liquidity pool. Let's just say they were trading $10,000 of Ethereum and they were getting out $10,000 of USDC basically. Now keep in mind, there is going to be something called slippage, which we're not going to dive too deep into in this video today. And that slippage is basically what adjusts the overall price of the token. But basically they're putting 10K of Ethereum in and taking 10K of USDC out. So if the initial ratio in the liquidity pool was 50K of each, well now all of a sudden there's going to be 60K of Ethereum and then there's going to be $40,000 of USDC. That's the basis of it, and that's how you should think about it. Obviously this is not going to be exact. This is a very high level overview. But this trader is trading through the liquidity pool. Now you're probably wondering at this point in time, well, how does money get into the liquidity pool? Well, that's where people like you and me and other liquidity providers or market makers come into play. Now, the beauty of decentralized finance is it's decentralized. Anybody can participate in this ecosystem. It's permissionless. It's not invite only like a lot of centralized exchanges are or a lot of brokerages over in the traditional financial space are. You can put up any capital amount and you can withdraw at any given time. Market makers come in here and they provide liquidity for both assets. So as opposed to them putting one asset in the pool, they're going to put both Ethereum as well as USDC in the pool, and that's what's going to allow traders to trade. Now, why would market makers put liquidity in a liquidity pool? Well, two different reasons. Number one, maybe they want to sell one asset for another asset. What I mean by that is when this ratio of the liquidity pool is adjusted, well, guess what happens? The market maker's position is adjusted. So if they had 50-50 of each asset, well, now they'll have 60% of ETH and 40% of USDC because more ETH came into that liquidity pool. And this will be similar to why people provide liquidity on traditional financial markets like brokerages and stuff like that because they want to sell their assets at specific prices. But also, as a market maker, liquidity provider, or whatever you want to call it, basically, you're going to get paid a small fee. And typically that small fee is about 0.3%. That's the average of where most liquidity is in the decentralized finance industry. So if it's 0.3% on $10,000, that's $30 right here, right off of this trade that goes over to the market maker. And this market maker can do whatever they want with this $30. They could go and sell it for a stablecoin. They can go and put it in their bank account. They could go and reinvest it back into the liquidity pool. They could do whatever they want because it is now now theirs. That is additional capital that they have made, not from price appreciation. It is a fee that they were paid for providing a service of liquidity. Now keep in mind, automated market makers are a lot more complicated than what I just described, because there's a whole algorithm behind it that essentially automatically adjusts the price of these liquidity pools. Because keep in mind, this person is making a trade that is worth 10% of the overall liquidity. Well, most likely they are going to adjust the price by 10%. So here's the interesting concept. These liquidity pools don't get their prices from CoinGecko, they don't get it from CoinMarketCap or any other centralized API or anything like that. They have their own oracle basically. Their price is set by the first liquidity provider, and their price is kept in check by arbitragers. And to further explain that, we're going to assume there are two different pairs. One's on a liquidity pool and one's on a centralized exchange basically. So over here we have ETH to USD, and then over here we have ETH to USDC. Now for simplicity purposes, we're assuming that USDC always equals $1. And that's because you can always redeem $1 for $1 USDC or $1 USDC for $1. Well, in the liquidity pool, let's just say some trading happens and the price is now 3,000 USDC per ETH. Notice how I'm not saying US dollars or dollars per ETH, because we're looking at how many of the quote asset equals one of the base asset. Same exact thing over here when we're trading ETH to USD, it's just the quote asset is USD basically. Keep that in mind. If we are looking at something like wrap Bitcoin to ETH, well, we're looking at how many of the quote asset equal one of the base asset. We're looking at how many ETHs equal one wrap Bitcoin. Now we're not going to be diving into that in today's video, but that's just an example over here. Getting back into it, let's assume that the price is 3,000 USDC per ETH, and then over on the centralized exchange, the price is 3,005 US dollars per ETH. Well, what can happen here is people can take their USDC, which remember they bought for exactly $1, and they can trade their USDC for ETH. So they're going to go over to this liquidity pool, they're going to execute a trade and trade USDC for ETH. And then what they're going to do is they're going to take this ETH and they're going to sell their ETH that they just got from the liquidity pool into US dollars basically. Now, why exactly would they do that? Because they just bought one ETH for $3,000 basically, and then they just sold it for $3,005. That right there is arbitrage, because now they keep that extra $5 per unit right there as profit. And they're able to do that instantaneously. Now keep in mind, there are bots that do this and there are bots that keep it in check, and there are not a lot of retail users that can get a hold of these bots. It's mainly the large institutions that have millions, if not tens of millions of dollars of capital that are keeping these liquidity pools in check and profiting insanely. And they're most definitely not sharing their algorithms or their bots, because they are very, very profitable, and the more people that use it and the more money that's in there, the more competition there is. Now, same exact thing can happen vice versa. Let's just say the price in the liquidity pool is 3,005, whereas the price over on the centralized exchange is $3,000 basically. Well, guess what? Somebody can trade their US dollars for Ethereum over here on the centralized exchange, and they could take that Ethereum, put it in their DeFi wallet, and they could trade their Ethereum for USDC basically, or then they could redeem their USDC for $1 basically, and they keep that $5 spread right there. And that's because the liquidity pool has its own oracle, it's its own market, and the liquidity pool has an algorithm behind it, which is the automated market maker that automatically adjusts the price based on how many people are buying and how many people are selling. So if the price is, let's just say, $3,000 and nobody is trading, well, guess what? The price is going to continue at $3,000. Whereas let's just say the price is $3,000, and keep in mind I'm talking about dollars in terms of USDC, and there's a ton of people, let's just say, swapping their Ethereum, so they're selling Ethereum for USDC. Well, then guess what? That price is going to be adjusted to the point where it takes less USDC to equal 1 ETH. Which, what does that mean? That means that the price is going down to maybe something like 2,900. Keep in mind, these are just random examples that I'm coming up with to demonstrate the fact. Or let's just say it's vice versa, where people are swapping a lot of USDC to Ethereum. Well, what's going to end up happening is the automated market maker will adjust the price from $3,000 to something like $3,100 or something like that, depending on how many people are actually trading. And those arbitrages that we talked about earlier are what's keeping that price in check. So long story short, an automated market maker is basically a liquidity pool that's automatically going to match every single trade. It doesn't have to require any manual work for anybody. All somebody has to do is deploy liquidity in the liquidity pool, and if somebody wants to buy at the price of $10,000 versus somebody wants to buy at the price of $1,000, it's always going to fill these trades as long as there is capital in the liquidity pool, and it's going to fill them instantaneously as soon as somebody executes the trade. Whereas with the order book model over on centralized exchanges, basically, what's going to typically end up happening is there has to be the buyer that is willing to buy at $10,000, and there has to be a seller that is willing to sell at $10,000. And they have to essentially execute the trade through the order book, and then once the trades are matched, it will be filled, and the order will be filled, basically. Or in the scenario where somebody wants to buy at $1,000 or something like that, same exact thing, has to match the buyer with the seller. So it's a much more efficient model for a liquidity pool because it's much more automated. automated. And the best part is liquidity pools are permissionless, so anybody can become a market maker and provide large amounts of capital and start to earn the fees that traders are paying. As somebody that's just like buying and selling over on an order book model, you're not going to be able to collect the fees that traders are paying. Now, if you're a market maker that has millions, if not tens of millions of dollars of capital, and you approach the exchange saying, hey, I want to market make for your exchange, they're going to be willing to cut you back a portion of those fees, not all of them. They're going to cut you back a portion of those fees in return for being a market maker and providing liquidity and increasing the efficiency of their order book because there's now more liquidity. But once again, there's a huge barrier to entry, whereas with liquidity pools, there is no barrier to entry. You don't have to have tens of millions of dollars or anything like that. None of that is needed. All you have to do is provide your capital into a liquidity pool. I want to talk about a couple different decentralized exchanges that follow this order book model. The largest one is going to be Uniswap. And if you've ever been in decentralized finance or even purchased some cryptocurrency and you keep up to date with the space or even keep up to date with crypto, you have probably heard of Uniswap. They are the largest decentralized exchange with $5.9 billion in TVL. They also happen to be the pioneer in the space that invented decentralized exchange and this automated market maker system. And they have invented many concepts in the space, including full range liquidity as well as concentrated liquidity, which concentrated liquidity essentially allows you to leverage without additional capital risk or anything along those lines. It's just simply allowing your liquidity to be used more efficiently, which is ultimately generating more fees. And in the past 24 hours alone, and keep in mind this is on a Sunday that I'm recording this, they've done roughly $1.2 million in overall fees that's paid out directly to liquidity providers. And I do want to go ahead and say that even though the crypto market is 24/7, we typically have the most trading volume during business hours, which is Monday through Friday, 9 a.m. to 5 p.m. basically. So to be doing that much in fees over the weekend, that is pretty good. Now there's also plenty of other decentralized exchanges, including Radium, which is on the Solana network with $910 million. There's PancakeSwap on the Binance Smart Chain network with $1.9 billion. And there are loads of decentralized exchanges. On DeFi Llama, we could go over to the DEX category and you could see that this is a $20 billion industry, which is roughly 20% or so of the overall DeFi market. And when I say this is a $20 billion industry, I mean that there's currently $20 billion in DeFi liquidity pools right now that is tracked. There's probably an additional $1 to $2 billion that is not tracked as well. But if you guys enjoyed today's video, make sure to drop a like as well as subscribe when notifications turned on. And of course, our website will be down below in the description if you guys are interested in getting some support with your decentralized finance portfolio and earning passive income on your crypto assets. I'll see you guys in the next one, and peace out.